Welcome this afternoon to another in our series of webinars. In August, we addressed the wider macroeconomic and strategic issues impacting short to medium-term investment across the full spectrum. Today, we want to target into equity strategy, both the macro factors and our specific approach. I encourage you to lodge your questions in the Q&A toolbar, and we've put aside some time at the end for Q&A. My name is Paul Ashworth, and I am the Chief Investment Officer and Managing Partner at Cameron Harrison. Our investment management team have been managing together for now over 25 years. Uniquely, our demonstrated investment performance track record spans the same period. Our success is undoubtedly due to the excellent people that have been able to develop and grow at Cameron Harrison. It is also because we are firmly not everything to everybody. Our sustained focus over 25 years has been to assist those clients, typically business owners and families, to build and accumulate wealth steadily through the various cycles and the ups and the downs. As you will hear this afternoon, the events and trends over the last 25 years now potentially make way for a new cycle. Specifically one where the previous trend returns will be replaced with volatility and the need for careful economic management. I'm pleased to be joined this afternoon by David Clark, who is a partner in the firm and manages our research and investment analysis division. He will outline Cameron Harrison's approach to our Australian and global equity strategy and how we are adapting to a significantly changed environment compared with the last 25 years. To start today's session, I will first recap the macro and financial market issues and strategy we view as central to effective equity investment over the next 12 to 24 months and beyond. We are at a crossroads, and central to both economic strategy and equities is the trajectory of inflation. We are presently going through a period of elevated inflation due to COVID-related supply curtailment, just-in-time bottlenecks, significant goods demand in the US, and consequential flow on to shipping costs, shipping containers being in the wrong place, and the collapse in discretionary service demand. An example where the supply side impact on prices can be vividly seen is container prices. Container demand is up a modest 5% from pre-COVID levels, which of itself shouldn't see such a significant rise in shipping container rates, yet they have risen up to fourfold. The problem with shipping rates is the logistics disjoint. There is a disproportionate flow of goods trade going to the US, with shipping containers being located in disjointed locations. The reasons are many, but the just-in-time dynamics of global trade supply have been currently upended, but will ultimately resolve with additional contracted shipping and capacity, and services demand re-emerging to rebalance US goods demand. Overall, we believe these type of price impacts will be transitory, and this appears to be reflected in final good pricings, which we can see here. On the left hand, we can see that core inflation expectations are moderate. On the right hand side, we can see the breakdown in the US of input, intermediate and final prices. Input and intermediate prices are elevated, but business is being restrained in passing these costs on to consumers through final prices. This reflects a belief that elevated prices due to supply issues is transitory. Similarly, transitory inflation is seemingly how both bond markets and equity markets are assessing current elevated prices. On the left-hand side, we see US core inflation at the black dot. At this level, a lower equity valuation multiple could be implied. Yet the equity market appears comfortable with the current transitory nature of inflation. Similarly, On the right-hand side, we see that the US 10-year bond markets are pricing lower for longer interest rates, with little concern for current supply inflation. Yes, there is presently some short-term volatility, but 10-year bond rates rising from 1.15% to 1.5% through the course of this year is merely some improvement in economic conditions from where and what were absolute lows. This is largely due to the question of when the Federal Reserve will begin to reduce its purchase of government bonds or taper. The other question testing markets is whether growth in the US has peaked. All this adds up to markets still selecting to look through the current supply side inflation and adopting lower for longer. We think this doesn't adequately reflect the changed economic landscape. We're of the view developed world and particularly US economic growth will be healthy through 2022. This will be driven by fiscal stimulus, still relatively low interest rates, even if they progressively rise through to 2024, accumulated savings and pent-up services demand. On the right-hand side, we can see that Australian household saving growth is elevated and ready to be utilised. Even if only partly utilised, the extent of household savings is a huge add-on to normalisation spending on services. These conditions are replicated in the US. On the left-hand side, this graph shows investment intentions by US business are robust. The investment data for Australia is almost identical and strong. Employment growth continues to build and fiscal stimulus has enough steam. But also, so too does the consumer and households. It is therefore from this position that we see healthy economic growth and earnings growth for 2022. For growth to be sustainable though, government spending or fiscal policy is going to need to continue to contribute. This fiscal support needs to occur simultaneously as monetary policy is required to normalise through tapering and the raising of interest rates. Again, this clearly has volatility written all over it. The conditions for economic growth are sound, and this is also reflected in corporate health. On the left-hand side, the exhibit shows margins for US listed companies are at highs. And uniquely, this has been achieved not at the expense of labour remuneration, which is a positive for households. A similar healthy rebound in margins has occurred outside the US. On the right-hand side, US corporate net debt is comfortably positioned. So in terms of general company health, after a short COVID health recession, corporates are in good shape. As I've mentioned, we see the current largely supply-side inflation pressures abating, but that more meaningful demand-side inflation may likely emerge. In particular, given our strong economic growth expectations and a view that the Reserve Bank here and the Federal Reserve in the US will act too cautiously to moderate monetary conditions, there is a high risk that broad-based inflation and wages pressure emerges. The re-emergence of demand for services will be a key watch point. On the right-hand side, we can see rents. Accommodation is the biggest component of US consumer price inflation. Asking rents are hugely elevated. The significant risk is that with immigration curtailed, wages growth elevates and feeds into inflationary expectations, fueled by real cash rates that are held too low for too long. This we can see on the left-hand side. Inflationary expectations have risen to more normal desired levels, but the real 10-year bond rate remains negative, as do cash rates. So this is the crux of today. The real cash rate set by the Federal Reserve first needs to be moved up to start approaching the neutral rate. This will eventually occur, but if it is too slow, then the risk is disorderly inflation and wages growth, with bond rates elevating past 4%. At present, they are 1.48%. The risk is that central banks are too slow and not definitive. This would see meaningful inflation overshoot. Whilst bond yields have elevated of recent times, they don't appear to be reflecting a belief in significant or sustained inflation. We agree with this to the extent of the transient supply-side inflation, but with a positive economic growth outlook, we view that markets are underappreciating the growth outlook and with it, sustained inflation and more meaningful increase in bond rates. It is under those conditions that we see a paradox ahead of us. That is, healthy corporate earnings growth on one hand is impacted by reduced valuation multiples and a rising bond yield. It is under these conditions of rising bond rates that high valuation multiple companies become relatively less attractive compared to companies producing growing cyclically leveraged earnings at more reasonable valuation multiples. Given the market's current relaxed view on more meaningful inflation in 2022, we view current valuations for well-conducted, cyclically leveraged businesses as still attractive and somewhat overlooked. For over 25 years, we have been focused on investing in well-conducted businesses at reasonable valuation for earnings growth. It is our expertise, it's our experience, and it's a well-honed prison that we have operated over this long duration. The outcome is superior long-term returns. Nothing ever remains the same. As managers with a strong economic and risk management strategy bent, we're acutely aware of this. We consider that our equity strategy approach is very well positioned for what lies ahead. So our key points. The assumptions of the last 20 years should not be relied on for the next 10 years. Inflation will be a critical element of strategy. Interest rates will be higher and capital costs more. Government spending will be more prominent. Government is more interventionist. Big tech is targeted. The global rules will be played harder, if not, in some instances, ignored. That high valuation multiples, particularly for growth label companies, become relatively less attractive. They still grow earnings, but they are relatively less attractive compared to other more reasonably priced enterprises. And finally, for us, appropriate value has never been buying cheap valuation multiples. It is about firms with quality corporate strategy and management that generates earnings growth at a reasonable valuation multiple over a medium time frame. So it gives me great pleasure to welcome David, who is more going to specifically address the elements of our Australia and global equity strategy. So thank you, David.
Thank you, Paul. So far, we've focused on outlining the current market paradox. This can be put simply as the better the economic performance, the worse the outlook for equity valuations. Now that we've identified the issue, I'm going to focus on how we are positioning our investment portfolios for the coming shift in interest rates. The first point of note is a very unusual starting position for markets. The COVID-19 driven recession was unlike any previous recession, with household incomes increasing and equity markets delivering stellar returns. This was largely due to extreme policy responses by both central banks in the form of interest rate cuts to near zero and quantitative easing to reduce long-term yields, and also government intervention in the form of stimulus checks and other spending packages. As this recession was a health crisis that then caused an economic crisis, it gave policymakers a head start to apply support measures. It is unlikely that we'll be so lucky next time. The end outcome is that instead of starting the recovery cycle with suppressed market valuations, which would normally be between 16 and 14 times forward earnings, we instead have markets at all-time highs and a PE ratio north of 22 times, a similar level to the dot-com boom of the late 1990s. Starting a recovery with high valuations changes the investment outlook by increasing the sensitivity of markets to changes in central bank policy, such as the tapering of QE or interest rate increases. So, do high valuations mean bad returns in the short term? In short, no. The chart on the screen shows the distribution of returns over 1 year in the green line and 10 years, the black bars, when starting with a valuation that is above 30 times on a cycle-adjusted basis, a position that we currently find equity markets. Over a 1 year horizon, the range of outcomes remains highly dispersed, with anything from a 40% positive to a 40% negative return possible. Also, despite the high valuations, the distribution is skewed to the right, implying a greater chance of a positive 12-month return than a negative. So despite the high valuations, it does not mean markets are certain to collapse in the near term. However, over a 10-year horizon, this is not so much the case. The distribution is significantly tighter, with outcomes falling within plus and minus 10% returns. Also, the distribution is skewed to the left. You're almost twice as likely to have a negative real return from this position as a positive. The key determinant is the timing of central bank tightening. So long as central banks hold their nerve and maintain looser monetary policy and don't start increasing rates, then returns from equity markets are likely to be good, driven by growing corporate earnings per share. But at some point in the next decade, it could be 2022, 23, 24 or later, central banks will like to normalise interest rates, and this will impact higher valuation companies. The silver lining for investors is that averages can be misleading. The higher market valuations tend to be driven by a small cohort of companies, typically technology companies. Using the US as an example, this group has been termed the FANGs or the FANG companies and is comprised of Facebook, Apple, Amazon, Google, Netflix, and Microsoft. Technology companies have been viewed in the past decade to be secular growth companies. That is, their future earnings are not impacted by the economic cycle. In a low growth environment in which we have been, the premium for these companies has expanded and they are now expensive. Yet, if we look at the broader market beyond this subset, we find many companies that are trading on more reasonable prices and are less susceptible to a derating of the market due to higher interest rates. So who are the winners and losers from high growth and rising rates? Fortunately, markets have already shown us the answer to this question. Not so long ago, at the beginning of the year, we had a taste of what the inflation trade would look like. As economies reopened, bond markets rose sharply, creating concerns over the impact of higher inflation. Then, as quickly as this occurred, the Delta variant forced many economies back into lockdowns and restricted economic activity. The turning point for this was the 13th of May, and we can see a clear delineation of performance across sectors in the months leading up to this point and the months after this date. This is shown in the bar chart to the right. As bond markets rose, the sectors at the bottom of the chart, industrials, materials, financials and energy, drove the performance of the market. Companies within these sectors have higher operational leverage to the cycle. As the economic growth accelerates, their earnings tend to grow even faster, offsetting the impacts of falling valuations. During this period, more secular growth sectors like utilities, technology and staples all underperformed. From the 13th of May onwards, we see the opposite occurring. Bond yields fall and tech and health do well, while cyclical sectors, industrials, materials, financials and energy underperform. As of today, we're yet again going through the same market gyrations, and the portfolio allocation implications are reasonably obvious. You want to be overweight the sectors that are leveraged to higher growth. For many investors, this is where the trouble begins. The 2010s produced one of the longest equity bull markets, with falling interest rates providing a tide to lift all boats. During this period, the allocation in the benchmark index of companies that benefit from low growth, low rate environment has increased dramatically. This concentration of stocks is best captured by the top 6 by weight in the index, 5 of which are in the FANG cohort, noting that Alphabet, the parent company of Google, has 2 classes of shares. The result is an index that is overweight the past, companies that have previously performed well rather than those that will perform well in the future. If the longer forever prevails, the index will perform well. However, if, as we expect and have outlined, the next decade is shaped by higher growth and higher rates, then investors need to have the courage to be significantly different from the index in order to generate acceptable returns and avoid a negative real 10-year return outlook predicted by past experience. To shift to look at our portfolios now, it should come as no surprise that we are very different to the allocation to that of the benchmark. The notable deviations where we are overweight are circled in red on the chart to the right of the slide. Firstly, our industrial allocation is 30% compared to under 10% for the index. The industrial sector can be quite broad. For our portfolio, this covers investments in logistics and railroads, such as Union Pacific in the US, equipment manufacturers like XP Power in the UK, and smart industrial companies like Honeywell. The common thread being they are business-to-business companies that benefit disproportionately as economic activity increases. The second point of difference is our allocation to consumer discretionary, which includes investments in home builders and home suppliers, automotive, and finally retail operators like Home Depot, which are a similar company to Bunnings. The key to inflation moving from what we currently consider a transitory environment to a persistent environment will be consistent wage growth. The sectors I've outlined above will benefit from higher disposable incomes. Finally, we are underweight technology companies. We do own Microsoft due to its excellent management, wide economic moat, and importantly, acceptable profits, unlike many of its peers. We also invest in industrial technology like Honeywell that focuses on business-to-business services, as they typically have higher barriers to entry. The end result is that we have a portfolio that has high forecast earnings and dividend growth without the need to invest in companies with sky-high valuations. To put this another way, it is higher growth for a lower price. To finish, I want to reiterate the key points from this webinar. 1. Inflation is coming. The first wave of inflation, supply-side inflation, will recede, but this will be followed by demand-side, wage-driven inflation and higher economic growth. 2. Higher interest rates and bond yields are a matter of when, not if. We expect central banks to delay increasing short-term yields for longer than previous cycles and believe that the market is generally too hawkish with expectations of a rate rise in 2022, with central banks more likely to act in 2023 or 2024. 3. A shift to a rising interest rate environment means that yesterday's winners are likely to be tomorrow's losers. To avoid this trap, investors need to be brave and diverge from market weightings. 4th and finally, many have highlighted the underperformance of value companies compared to growth over the past decade and have mistakenly expected this to converge as a matter of reversion to mean. This won't occur until we exit the lower forever environment, a point that we believe we have now reached. And we see great opportunities for dynamically managed and profitable cyclical companies. With those final points, I'll hand the reins back to Paul, as I believe we are doing a short Q&A session.
questions in the questions section. We've had a good question in terms of shipping rates, and that is when do we see shipping rates coming down? The key things that are really twofold. That is the shift away from US goods demand and a rebalancing to services demand in the US economy. And that we would anticipate to occur in the second half of the year. It is anticipated that with capacity that's currently being built and also container logistics, that there should be some easing towards the end of the year. It'll be substantially in terms of that rebalancing of demand out of the US, which has been dominated by goods demand. We've had a question in terms of the new entrants that have come into the global equity strategy, and what are the type of drivers that sees those companies enter. I might pass to you, David.
Yeah, I think the starting point, as it always is with our new entrants, is the management team. So what separates these companies away from their peers is to the quality of the management. And I think this year, this review cycle has been some of the strongest new entrants coming through that cycle that we've ever had. Certainly what they all share is valuations that we think are very attractive, and I would go as far to say that we'd even be willing to buy them at higher multiples than what they are currently trading at. And it was, I guess, to pull out one of the new entrants, Steel Dynamics, which I mentioned during the presentation. It's certainly a very interesting company that could benefit not just from its quality management team and spending on infrastructure, but also if we do see that shift in trade between China and trade wars and the like coming again, then being a domestic producer of goods is going to be an attractive position to be in.
Great. Another question is, how do you think the more aggressive stance by China against Australian companies will affect Australian stocks? Certainly China is very present in the news, both politically and in terms of the Evergrande Group and possible collapse. Look, I suppose it really lends itself is what is our picture for China, and how is it that we view it in terms of investment implications. We put a note out on this a few weeks ago. Social stability is the policy for the Chinese government. Where that is threatened, that obviously causes implications. What do we think? Their banking system or banking sector is broke. It can be recapitalised, but there's probably only one more bank capitalisation left for China in terms of utilising its foreign reserves. The second key aspect is their ageing population and demographics, which is rapid. That has very significant implications on economic growth. Really, the key thing, therefore, is economic growth. And how does that impact us? Well, we would expect, on proper readings of data, which is more often than not difficult in China, that economic growth in China will be under 5% in the not too distant future. So for Australia, it does have implications. It has newsworthy implications. When lobsters, live lobsters, are sitting on tarmacs, it doesn't make for good news and good press. But it's not significant in terms of export dollars. The name of the game is bulk commodities, and perversely, they've continue to do well, notwithstanding the actions of the Chinese government. And we're again now seeing that in terms of both coking coal and more particularly in terms of thermal coal. Our key exports are bulk commodities priced in world markets. If China doesn't buy them, China has to buy elsewhere, and that has allowed Australia, within those bulk commodity markets, to clear at the market price. So the impact is significant, but it's not diabolical. But over the medium term, we do see that those bulk commodities will come under some pressure as Chinese economic growth is heading lower. Well, there are questions for today, so I thank participants for those questions. But above all, I thank everyone for their joining us today, their participation, and we wish you all well, and hopefully we can all get out, and we are looking forward to doing such events in a normal format, which is in a more convivial, face-to-face environment. Depending on how that transpires, we have another session coming up, which will be a very interesting one. It is Australia's national pastime, and that is property. And we will be conducting a property symposium across industrial property, residential property, and the investment and economic implications in relation to property investment going forward, and that'll be occurring in the next month. So we hope that you can join us for that. In the meantime, be well and keep safe. And thank you.